Today's episode is an important public service announcement to warn you of an illegal, naked short selling scheme that a lot of beginner and even experienced traders are getting caught up in. All of this has come to light thanks to a lawsuit that was recently filed. In that lawsuit, allegations are put forth in court documents that walk us through the inner workings of how this scheme functions, and it is mind-blowing. It's so much bigger than I would have guessed, and I'm going to tell you, if you've been trading for the last 6 months, you have seen this scheme happening right on the level 2 and right on the charts, right before our eyes. We've been talking about it. We've been asking, how is it possible that a stock could come out with good news, squeeze up, and then there's an infinite wall of selling? What feels like an algo pushing the price right back down. That has been naked short selling. Okay, that makes sense. All of a sudden, yeah, because we've been seeing that and we were trying to figure it out. So thanks to this lawsuit, we now have an understanding of how it works, and that's what I'm going to be sharing with you here today. Now, I wish I could say this is brand new, but it's not. This has been going on for a long time, and even if this current short selling scheme gets shut down, another one will pop right back up. Now, to be clear, short selling is not illegal, but naked short selling is. If you don't know the difference, you will by the end of today's episode. So let's begin by playing a clip from the HBO documentary Gaming Wall Street. This is a former Morgan Stanley banker talking about his experience naked short selling. Let's hear what he has to say. This is going to set the tone for today's episode.
I would illegally naked short sell stocks every day. Every day. As long as I was collecting commissions.
There it is. He would illegally naked short sell stocks every day, as long as he was getting commissions. He goes on to say,
and the bank did not care.
The bank did not care. Now, in today's episode, we have a special guest. He is a former attorney at the SEC. His name's Nick Morgan, and he is also the founder of a nonprofit law firm, ICANN, Investors Choice Advocates Network. So, Nick, are you ready to jump in and pull back the curtains on everything that's been going on here with naked short selling?
I'm ready, Ross. Let's pull back the curtain.
This is a theme it's a theme that's been true for years. This is true before the GameStop short squeeze, and it's still true today. Now, we're in a current regulatory environment where I fear that there's not as much attention on reining in these big institutional players and these big brokers. Now, I could be wrong. The rules are the same. They've been the same. Nothing has changed with the rules, but the enforcement of the rules seems to vary a bit, partly from administration to administration, the political climate, and the whim of the regulators. And for whatever reason, naked short selling has been unable to be fully reined in. So as I walk you through this scheme, we're going to begin part 1 with the bait. How are people getting involved in it? Are you involved in it without knowing? Well, this is how it starts. Posts on social media of people showing a chart like this with a bunch of red arrows going up. So as the price goes up, what they're doing is they're shorting. And they're adding as it goes up. And they say, this is easy. It's emotionless. You just add every X percent that the price goes up. And then, look, nothing goes up forever. The statistics tell us that even the biggest moves like GameStop eventually come back down. So as long as you leave yourself room to keep adding, you'll be fine. And then you cover as it comes back down. And the best part of this is that you can automate it. It's a systemized short selling strategy. You can turn it into your own trading bot, your own algorithm, and it will trade the market for you while you're at work. What could be better than that? But you've got to use our special broker, because you can't automate this type of trading using a Schwab or Robinhood or Webull account, of course. You've got to use one of these special boutique brokers. So what they tell you is that you don't need scanners, you don't need charts, you don't even really need to know how to trade. You'll have a high win rate, you can automate your trading, and you can just use the statistics to create an algo. What could be better than that? But there's a catch. You can't trade with the trend like I do. You may know that I'm a momentum trader. So I look for something that's already moving, and I look to jump on that momentum and continue to ride it as long as I can. Now, this system of algo trading doesn't work for trend trading because it's just not something that it's able to do at this point, just due to the complexity of knowing the discretion of, do I jump in this stock right here that's already up, 100+%, or is this too extended? Now, those are the discretionary decisions that I'm making as a long bias trader. Now, I'll tell you that historically, long bias traders have kind of been thought of as being the dumb money. They jump into anything that's moving. During the dot-com bubble, the OTC pink sheet penny stocks, and it was the short sellers who were a little bit more sophisticated that would bring the price back down. But then short selling became so popular that the short selling sector became quite crowded. And as it became quite crowded, there were a couple issues that you're going to learn about today, including availability of shares to borrow. Now, trading to the long side, you don't really have to worry as much about it being crowded because the shares that you buy are all part of the float. And as people buy shares, the price goes higher. But when you trade to the short side, you need to have the shares available to trade first. So if you're going to trade a system short selling strategy, number one, you're not trend trading. You're counter trend trading. So what that means is that as a stock goes higher, you're shorting, or as a stock goes lower, you're buying. Now, a simple algo for retail traders is just not sophisticated enough to know that you could buy in the middle of a trend like this right here at $8. This stock just went from $5.50 to $8 and, reasonably is very extended, right? That's a very extended stock. Probably anyone typically looking at that on paper would say this is not a good place to buy, right where my white arrow is. However, what we knew at that moment was that that stock had a very specific catalyst, that the theme in the market was that these stocks with these catalysts are making huge moves. And so for all of those reasons, we were able to make the discretionary decision to take the trade. And I lock up $156,000 of profit, as you can see right here. On the previous slide, I had $169,000 of profit doing something very similar, making the discretionary decision to buy in the middle of a trend. That discretionary decision cannot currently be automated to an algorithm, not in a successful way, because there's too many variables. However, counter trend trading is a little bit different. So trading bots only trade reversals. And what they do is they add fixed shares at fixed intervals. And they could do it either long or short. So as a stock is going up, they add, and they add at these fixed intervals. And then as it comes back down, they're covering and covering and covering. And this makes it feel very simple and very easy. So certainly the algo could work on buying weak stocks, but we're not talking about this. We're talking about naked short selling. So why is that? Well, when a stock is weak, especially a small cap stock like this, often there's panic, there's fear, and it takes a long time for people to become greedy and want to buy a stock that's down 50% or more. For that reason, it's very difficult to trade bottom reversals and expect a big rally back up, especially on small cap stocks. Usually when they're dropping, it's for a good reason, and so the bounces are very small. So if you start adding, you never really get the relief bounce to give you profit. But with trading to the short side, because the market is fundamentally long biased, companies want their stock price to increase. They're constantly putting out good news. And in a hot market, investors and traders experiencing FOMO and greed, stocks are more likely to trade at overbought levels versus oversold levels. So this means there are more opportunities to trade reversals short versus trading reversals long off the low, especially in the small cap market, which naturally is more appealing to beginner and intermediate traders with smaller accounts. So this leads us right into naked short selling. Well, it doesn't have to be naked, but in this case it is. So the idea with a short system, a short selling system, is that you use statistics to create your strategy. And so the idea here is that nothing goes up forever. We know that. And so as long as you leave yourself room to continue to add, then you'll be fine. And this, in theory, is true. You take a starter here, and if it immediately reverses, you have a winner with 1x position. If you add to your second starter, your second add position, then it reverses here before the third, you have a profit with 2x a position, or 3x, or 4x. And at a certain point, you get that reversal. So the idea is that you add 100 shares when the stock is up 50%. For instance, you add another 200 shares when the stock's up 75%. You add another 400 shares when the stock's up 100%. And by increasing your share size as the price moves higher, you're also increasing your cost basis. So when it rolls over, you'll be at profit sooner. And so you see how you keep doubling up. You go 100 to 200 to 400 to 800 to 1600 to 3200 to 6400. So in this scenario right here, this works as long as the stock doesn't go up more than 500%, and you have the buying power to have a full position here, which is the culmination of all of these shares added together, plus your final add. So in theory, it works great. You remove emotions, you systemize trading, you systemize shorting. You're essentially trading against the very low probability of a 600% move. This, however, is a martingale strategy. So this strategy, its Achilles heel is a black swan event, because if a stock does go up 1,000% or more, you end up taking that loss. But for every other time that the stock only goes up 300% or 400%, you may not get to your final add before it rolls over, and then that's fine. So this is a strategy, unfortunately, where traders can do really well for a long time until the black swan comes along and wipes them out. And so that actually creates an illusion during the period that things are going well that this system is awesome and I want to trade it with more and more size, until you get that black swan where you give back a lot of profit. Now, whether you give back all your gains or you give back, just a portion of your gains, ultimately depends on how quickly you're able to exit the position once you hit your max loss. What we know about trading these types of stocks is that they can move extremely quickly. We've seen times where stocks have gone up 1,000% in as little as 5 minutes. So if your algorithm was not fast enough to exit that position, then suddenly, you're down substantially, and you could even have a margin call to your broker. We'll talk more about that in a minute. So in the past year, we've seen a lot of these moves where a stock will come out with news, it'll start to squeeze up, and then it just gets hammered right back down. And it's been very confusing why a stock with seemingly good news would be unable to hold these levels. And we've called them round trips. The stock pops up, is not able to hold, and it comes right back down. So a martingale strategy is high risk, but by itself, it's not a scam. You could use it. It's high risk. That's all it is. So the idea of doubling each time you add, that you'll eventually make back everything you lose, is correct, except that you have limits of scalability, and at a certain point you run out of equity in your account. So the reason that it's being used as the basis for these trading bots is because it can be automated. You just add as the stock goes higher. It feels easy, and it has high accuracy. Now, it feels easy. It's not actually easy when you factor in the black swan events, right? But this is the way it's marketed. And so can you trade this strategy and automate it with Schwab, Robinhood, or Webull? And the answer, of course, is no, you can't. You cannot do it. They don't have good access of shares to borrow. So now, to trade this strategy that feels so alluring, this is the bait, you have to use a broker that allows API for trading bots, has large availability of shares to borrow, has reasonably priced borrowing fees, because anytime you borrow a stock, you have to pay a fee on it, and has flexible margin requirements, because if they make you, have a lot of equity in your account to take these trades, then that's not going to work either. And so now you've got thousands of affiliates all pushing leads into these special brokers that are allowing naked short selling. This is a problem. So, Nick, can you give us a little bit of context around when people make these posts on social media, when there's an affiliate relationship? Because most of these posts don't make any disclosure about that at all.
Right. Well, there's a real concern at the SEC about manipulative conduct by traders. And that manifests itself in a number of rules and enforcement actions by the SEC. But when someone is talking about a stock, and unbeknownst to the people reading the posts or the articles or whatever, they actually are being paid by an issuer or a broker, the SEC wants that to be disclosed so that people who are receiving the information know about possible conflicts of interest. So I think it's pretty widespread that the disclosures are not always as robust as they could be.
So part 2, now we've got to talk about these brokers that all these affiliates are sending leads to. So the broker makes money every single day, rain or shine. They make money on platform fees. They make money on the API fees for system trading and trading bots. They make money on commissions, and they make money on short borrowing fees. Now, these brokers are not commission free. So every time you trade, you're going to pay a fee. Now, these fees typically are based on a per share basis or charged on a per share basis. So 1,000 shares times 0.005 is a $5 commission. So $5 to trade 1,000 shares to buy it. It's another $5 to sell it. So if you end up doing 10,000 share positions because you're scaling up, you're paying $50 total to buy and $50 to sell. That's $100 round trip for the broker. That's the commission that you're paying. So now you can see how the broker's making hundreds of dollars per day per customer. You multiply this by thousands of customers and you add on the additional fees and everything else, they're making a lot of money. So with that profit, they're paying affiliates to keep driving fresh leads. But there were two problems. Now, again, all of this is perfectly legal until you introduce naked short selling. A martingale strategy, it's high risk. Eventually you could have a blow up, but it's legal. You could trade it if you want. Trading the short side, that's legal. But the way it works when you're trading the short side is you have to borrow shares from someone who owns them. Too many short sellers meant the brokers were running out of shares to borrow. And the result was that it was increasing the cost to borrow for everyone. And so a lot of the big money traders were going to the broker and saying, hey, I've got a $5 million account with you. I want to short, 100,000 shares of this stock. And the cost is outrageous, or I don't even have shares to borrow. I can't find any. So you know what? I'm going to close my account. I'm going to go somewhere else. And the broker's like, no, don't do that. Don't do that. We're going to figure this out. So for their top, heavyweight traders, they don't want to lose all the commission they're making on them. So they have to figure it out. And for all these new leads that are coming in that are doing the system short selling, they don't want to lose out on that profit either. So they got to figure something out. Now, if you actually look at the charts, I use this software called Ortex, and it shows you the cost to borrow. And on this particular stock, PLAG, the cost to borrow was up 315% just in the last 3 months, and most of that was in the last 14 days. A 315% increase in the cost to borrow. So the cost to borrow was going up. Why was it going up? Because everyone wanted to short it because it made a big move. But what's worse is that there was only 3%, less than 3% shares available to short. The remaining 97% of the shares that were totally available for shorting are already spoken for. So not only are you paying an elevated cost, there's hardly any shares left to borrow. So now this is a problem. You try to borrow and it says symbol not eligible. Nope, no shares available. So my broker does this. It says no shares available. Now, fortunately, the broker that I'm using does not involve itself in naked short selling. So they just say, no, sorry, no shares available. That is what it is. Whatever. Now, if there are no borrows, if there's no borrows on shorts, the system short sellers will close accounts. The heavyweight traders close accounts and the brokers lose business. And so all of a sudden the pressure is on. And this is where we come back to when the pressure is on, what are we going to do? I would illegally naked short sell stocks every day. That's the quote from the banker. And so this is a former Morgan Stanley employee saying that. And what they would do is they would press an F3 button on the keyboard, the broker would, to auto-locate shares. In 2016, Goldman Sachs pays $15 million settlement on allegations made by the SEC that they were using an F3 button to auto-locate shares. They're not alone. Merrill Lynch, Goldman Sachs, UBS, Morgan Stanley, Interactive Brokers, all of these have had abusive, illegal, naked short selling fines. This is widespread. This is not a small thing. This is happening across the market. It's happening on large cap stocks. It's happening on small cap stocks. It's happening on, these random sort of Chinese stocks are popping up. It's across the board. So then if we take these relatively small penalties sort of as that these were administrative bookkeeping issues, they paid a penalty, which in the scheme of the size of these companies is very minuscule. Have there been more well-known instances of actual naked short selling schemes that the SEC has prosecuted or that have been alleged and that something has come of it? Or is this just something that continues to kind of happen without much action?
Yeah, well, kind of both. In other words, the SEC has brought a number of actions certainly from the perspective of shareholders in a company or management of a company, being the subject of a persistent naked short selling campaign is devastating. And so there have been some historical examples where companies got really incensed and tried to do something about it. The one that comes to mind immediately for anyone who's kind of been in the space for a long time is the famous case of Patrick Byrne and the company he was CEO of, Overstock.com, which was the subject of a persistent short selling campaign. He became so incensed by that he went very public, filed a number of lawsuits, complained loudly to the SEC. And ultimately, I think he was so frustrated by what was going on, he attributed the conduct to what he called a Sith Lord, who he viewed as sort of a puppet master behind the scenes, coordinating the efforts of naked short sellers and the press and the regulators. And ultimately, I don't think he was right that there was a Sith Lord conspiracy, because frankly, it's a lot more boring and mundane than that. It doesn't require a conspiracy. All it requires is sort of knowledgeable exploitation of the way the system is set up by people kind of doing ordinary kinds of things.
That's very interesting. And so with naked short selling, now you get a broker that gives you, quote, guaranteed borrows, automatic locates, which means you don't even have to locate. You just press the sell button and immediately you're short, like magic. Yeah, it's magic. It's not real. In fact, what you're doing is you're selling shares that don't exist. So let's just think about how this works for a second. So if you want to go short, this is legal short selling. So legal short selling is you've got someone who owns shares. You've got an owner of the stock. They bought 10,000 shares of Robinhood, whatever it is, and they own it. Now, what Robinhood does as a broker is the broker lends out the shares from one customer to another customer. So this is the borrower. And now the borrower can now sell the 10,000 shares on the open market. The stock goes down. And this is all while this person is still holding the shares. They still have a position in their account that they're long 10,000 shares. If they sell the 10,000 shares, then immediately the broker needs to get back these shares from this person or replace that borrow with another borrow. So this person's holding the shares, this person sells it. The price declines, they buy back the shares, 10,000, they make, let's say, whatever amount of money, doesn't matter, and they then have those shares given back to the original owner. Now, the owner earns a tiny little fraction of interest, and the broker also charged this person interest to be borrowing those shares. So every time you short, you're shorting shares and borrowing them from someone out there who's an owner of the share. And the broker sits as an intermediary that makes a profit from loaning out shares. Now, during the GameStop short squeeze, there was a lot of discussion about restricting the ability of your broker to let people borrow your shares. And so you can actually go into your settings on some platforms and say, don't lend out my shares. I don't want that. So you could do that, but most people don't do that. And so the result is that your shares are lent out. All right, that's fine. But there are instances where stocks have a very low float, and there's simply not a lot of shares at brokers that are available to borrow. And so this person wants to borrow and they can't. But the broker could say, well, you know what? I'm just going to give you the 10,000 shares. I'm going to press that F3 button on my keyboard. I'm just going to give you the shares, and I'm going to figure it out later. I have reason to believe I will be able to get the shares. That was what the F3 said. I have reason to believe. But they didn't have any reason to believe. That was the button they pushed.
If I'm a broker and somebody comes and sends me a bunch of short sale orders, the regulations require that I have a reasonable basis so that I can go out and borrow shares to match against those short orders. Well, they do it by various means, but the reasonable basis can be created by just looking at what's the inventory of shares out there. And that can give me a reasonable basis to think I can borrow. But at the same time, the broker next to me is doing the same thing and looking at the same pool, and the broker next to him is doing the same thing, looking at the same pool. So it's as though you were a travel agent booking seats on an airplane that has 100 seats. Everyone's looking at the same 100 seats. If you've got 50 brokers all, thinking they had a reasonable basis of 10 seats per broker, you can see how you could easily exceed the number of seats on the airplane because we're all looking at this same pool. So it's the ambiguous nature of who owns which shares at which point in time that allow the brokers to have a reasonable basis and basically over promise shares to short sellers that are coming in. And the brokers, they want to satisfy their customers who are putting in short sale orders. And so there is an incentive to be less fastidious about how reasonable is your belief that you could go borrow these shares if you wanted to. So that's the real problem. It comes from a good thing, a good innovation that has created some problems, and traders and brokers know about this and can sort of take advantage of it.
So then to expand on the F3 button that Goldman Sachs was using, on the one hand, if you've got all of these brokers checking an inventory, the inventory may not be updating in real time, second by second, when people are actively buying and selling so rapidly, which we know, even if those of you who have tuned in and watched me trade, how within seconds I could be an owner, and then I'm not an owner, and then I'm an owner again, then I'm not an owner. So essentially, if there's shares available, they would, or if they had the reason to believe, they would press the F3 button, or how exactly did that work? You know better than
well,
I.
I mean, anyone can go read the SEC's allegations against Goldman in that case. And so Goldman, like all brokers, had this problem of short sale orders are coming in, and they need to establish that they have a reasonable basis that they can borrow. So what they did was at the beginning of every day, and this is all automated, computerized, they would have an inventory list for each ticker. How many shares do we know that we have in inventory that can be borrowed against for short sale? So fine, you've got 10,000 shares of whatever ticker. But then over the course of the day, if short sales came in that exceeded that, then they had to go to a manual process to determine whether, we need to maybe call a customer to see if we have additional shares we can borrow beyond what was on the beginning of day list. And over time, that was really cumbersome. And at least the way the SEC alleged it against Goldman, they eventually created this F3 key solution where traders who had short sales coming in could hit the F3 key, which sort of short-circuited the inventory issue and gave the brokers the answer that they wanted, which was, yes, I have a reasonable basis to believe we have shares that I can borrow. And the SEC said, no, you really don't. The F3 key was an illusion that gave the brokers the belief that they could borrow shares when in fact, in many cases, they did not have sufficient inventory. So the F3 key is just a reference to Goldman's solution to the same problem that every broker has, which is how do you satisfy customers who want to do short sales and satisfy your regulatory obligation to identify or have a reasonable basis that you can borrow shares to satisfy those short sales.
Interesting. And so then if you had a dozen or so brokers all working on that same beginning of day inventory, and also just sort of going on the assumption that maybe they could get more shares somewhere,
right,
then all of those brokers could sell short in theory.
Yes.
And if they all did that, you would have many multiples of the total shares outstanding now short.
That's right.
On the open market.
That's right. Yeah, that's right. And so that's the problem. That's the sort of overbooking the seats on the airplane because you're all booking against the same, 100 seats on the airplane. And by the end of the day, you've exceeded it. So, that would result in a fail to deliver, and that would get resolved in other ways. But that is the problem.
So then what is the real impact then in the market when you have 10x number of shares being sold? You've got artificial selling, essentially, like phantom shares.
Yeah, that's exactly right. These are now shares that have been sold by the short seller that don't exist. And so particularly in microcap stocks that are thinly traded, this can have a big impact on the share price, just like normal selling can, and just like regular non-naked short selling can. But this adds sort of accelerant to that, where you're selling shares that don't exist. So these are in fact like phantom shares.
Now they buy back the shares inside of a day as day trade. It's all covered, and all's kind of well and done. They didn't get squeezed, whatever. Except that the broker, yes, they make their commission and they're happy about that, but they've now engaged in naked short selling. So a lot of these brokers that offer guaranteed borrows, automatic locates, or offer discounted or free borrowing rates for big money traders and or big affiliates, to me, that's a red flag. It doesn't mean necessarily that they're naked short selling, but that's a red flag because you have to ask yourself, where are they getting those shares to borrow? And how are they offering free borrowing or discounted borrowing when you still have to pay interest to whoever you borrow the shares from? So all of this whole scheme with naked short selling has resulted in more affiliate marketing. All right, so we shouldn't be surprised about that. More affiliates promoting system short selling. And again, it's short selling because there are more opportunities to trade these to the short side in the market because the market is fundamentally long biased. The big P&L screenshots making it look easy, the links to the affiliates at the brokers. There's more system short sellers, broker makes more money, and more selling suppresses the price of the stock. So now we're seeing bigger rejections and bigger profits for shorts. So now let's do another scenario. Let's pretend we've got a stock with a 1 million share float. So that means there's a total of only 1 million shares available in the entire market. And then you have the broker here, and then you have system short sellers. And let's just say the system short sellers cumulatively have asked to borrow 2 million shares across, 10,000 accounts or whatever it is. And they sell 2 million shares. Well, wait a second. You're selling more shares than actually exist in the float. So, of course, you're going to suppress the price of the stock. There's not enough shares in the float of people that own it to buy and to hold it up. So what happens to the price? It goes down. Perhaps in spite even of a good news catalyst, the price declines. This should not be possible. It should not be possible to be able to take a short position in excess of the float, except when naked short selling is involved, which again is illegal. So this is the feedback loop where naked short selling has become more and more popular. But as I said, there were two problems. The first was too many short sellers meant the broker was running out of shares to borrow and it was increasing the cost to borrow for everyone. They solved that with naked short selling. But the second is the short squeeze. Because what happens if you do get a stock that just keeps going higher and higher and higher? Then all of these system short sellers with 2 million shares to the short side and the stock goes up 1,000%, who's in trouble? Well, sure, the system short sellers, their accounts are gone, and now it's on the broker. That's the expression. If you owe the bank $1,000, that's your problem. If you owe the bank, $10 billion, that's the bank's problem. So when you've got this big of a position and they're deep in the red, now the broker is the one who's getting scared because they could be stuck holding the bag. So big short squeezes, blow-ups, and margin calls are bad for traders, sure. They're bad for brokers, though, and they're bad for business. But how do you stop short squeezes from happening? And that gives us this brand new short algo that we saw launch earlier this year, selling a seemingly unlimited number of shares, run at an institutional broker level. And this is where we saw it right on the level 2, MEMX. We would see this big seller. Now this one right here is for, it shows 114 shares, but there's 2 zeros. So it's 11,400 shares. And what we would see is that this algo would pop up as soon as the stock was up more than 50%, we would see the algo come out and it would suppress the price. And it's like it was allowing the system short sellers to have an easy layup because it was just selling and selling and selling. At a certain point, you create enough weakness just through all of that selling, the chart is ruined. Everyone gives up on it. And at a certain point, sentiment becomes so poor because people just say, this is ridiculous. What are we doing here? I'm not going to keep trading this type of stock because every time I try, I just end up getting smoked. And so the result was that this MEMX algo created such bearish sentiment in the market. Every time something would pop up, it would reverse. People stopped trusting it. They weren't feeling safe trading these. And so what you ultimately had was a period where the market got very cold. Stocks, even with seemingly good news, were popping up and failing dramatically. Nothing was able to go up 500%. The system shorts were winning. Now, I actually have a video that I'm going to share with you. I'm going to put it up on my screen, and I'm going to walk you through what it actually looked like to see this algorithm in real time. All right, so we've got a live archive here where you're going to see this MEMX algo at work. Now, this is an interesting one because the stock is not up more than 50% here. However, versus the previous 2 days, it's holding right at a very critical level. and $5 is the breakout spot. So now we're coming up to 8:15 in the morning, 8:20 in the morning, and we see MEMX is sitting there at $5 with 50,000 shares. That's a big sell order. So let's keep an eye on that sell order. Let's watch how it moves. Okay, so currently stock's up 18, 19%. The order starts to get bought up a little bit. It was 50, now it's 49,300, 400. The order disappears. It gets canceled and moved up to 526. You see that? Now it's at 27. Now the order's at 40. Do you see how it moves? The fluidity of how it moves is indicative of an algo. It's not like cancel and slowly replace. It's instantaneously moving. So let's just back that up. There were two behaviors that we saw with this algo. One behavior that we saw with this algo was that it would keep sell orders just slightly above the current market to almost put a ceiling on how much the stock could go up. It was always like 10, 15, 20 cents, just slightly above the current market to create this impression of upside resistance. And so when you constantly have a big sell order hanging right over the ask, people get nervous to buy. And so that creates an impression of weakness. Now this order was moving up and then moving down, and then it was very fluid, as you could see right there. And so that was the first form of order spoofing and manipulation that we saw from this short algo, where they would put out this order to what feels like create the impression of weakness, but not with the intention of the order executing, because as soon as the order starts to execute, they pull it back up. So that feels like order spoofing, which is also illegal. So then we have the second instance, which is, so in that first instance, they're not really selling that many shares. They're just using big order size to scare other traders and to create this kind of area of resistance. And then in the second instance, we're actually seeing it executing and selling shares. So let's watch this again. So we're at 50 here. Someone buys like 700 shares. All right, so a little bit gets bought. And if they're trying to create the impression of weakness, but they don't actually want to short that position, then they cancel the order and they move it. Canceled order, moved to 526. Now, someone who genuinely wanted to sell the stock doesn't cancel the order. You sell the stock. Anyway, so it goes to 27 in an instant. Then it goes to 40. And then it comes back down to 16. Do you see that? So they took the ceiling off, giving the impression that, okay, maybe we can go for a second, and then they come right back down. Now it's up at 21, 22, 21. Now it's at 37, and it's gone up to 39,000 shares. Now it's gone. So where is it? Is it gone? This algo is now, are we clear? Could I take a trade on this now for a squeeze up to 6 or 7? I mean, what's going on here? And you can't really tell. So to me, the amount of times that we saw this unfold, I couldn't possibly count them. And so you guys who are tuning in, watching this, who have been trading for the last 6 months, you've seen this price action. And what I kept saying was, look, this will end in one of two ways. One way is whoever's doing this is going to get in trouble. Sadly, because of all just the current state of the government and all the staff layoffs and everything that's happened in the past couple of years, I don't know that someone doing this is going to get picked up. I really don't know. And if they're being enabled by an institution, a big broker, or their clearing firm, whatever, then yeah, we might not see it go anywhere for a while. So then the second scenario is this will go away when you get a big squeeze. If you get a big squeeze where someone puts out that 50,000 share order and they get filled because traders realize, well, this stock actually has a really good catalyst. It's got a really good catalyst and this thing is going to go higher. Then suddenly, they're short 50,000 shares. And I'll just give you an example of a stock today. We had a stock just today, and I'm not kidding, this is unbelievable, where the stock in 10 seconds went, you could see right here, from $1 to a high of 18. You do a move like that with 50,000 shares, you're losing $50,000 each point. So you're down 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60, 65, 70, 75, 80, 85, 90, nearly $1 million gone in 10 seconds. Now the price came back down, but if what if it kept going higher? Then all of a sudden, you're really smoked. You're in a real pickle. So as you see that type of behavior of the way that order moves around, what does that make you think, and sort of putting on your regulator hat?
So my regulator hat requires me to be cynical and assume there's a bad motive going on there. But one thing that it could be is an instance of spoofing, which is where someone places an order they never intend to fill, which is intended to send a signal to the market that there is interest in purchasing or selling, in another context, at a certain level that doesn't actually exist. So that happens a lot. And with automated trading, it can happen on an automated basis. I mean, with an algorithm, for example. So we know this occurs. Every once in a while, the SEC brings a spoofing case. I will say, from the SEC's perspective, very hard to prove, because you need to prove that there's something deceptive or manipulative about the order you placed. So an innocent trader could say, yeah, I'll put an order out there, X number of shares at such and such a price, and then I change my mind for perfectly innocuous reasons, right? That's the defense explanation for why that happens. So the SEC has to prove that if they're going to bring a manipulation case around spoofing, that the person did not have the intent that was expressed by the order that was placed and then rescinded. That's hard to do unless you have like contemporaneous emails or chats or something where the person's saying, I don't really intend to fill this order. So that's one possible explanation for this, is that this is spoofing intended to manipulate the price of the stock. We know that happens. That could be what's going on here. Alternatively, it could be someone or a number of people who are putting in orders and changing their minds. But the pattern you just described, that doesn't look like that to me.
So this behavior was very prevalent earlier in the year. And what was very interesting was that suddenly it stopped. And we were like, what just happened? And it was crazy because even stocks with seemingly good news, because of this algo, were going red on the day. And it was beyond frustrating. We were sitting here trading and it was like, man, I don't even know what to trust right now. And so naturally I was trading less during those couple of months. I wasn't trading to the short side. I wasn't that depressed, but I was trading less, and I was just like, well, we're in a slow period, but when this thing blows up, and eventually it will. Look, GameStop blew up, $7 billion loss for Melvin Capital. The Volkswagen short squeeze of 2008, $30 billion losses for hedge funds, short selling. So it's only a matter of time before you get a black swan that really squeezes this thing. And when that happens, then all of a sudden sentiment and momentum is going to shift really quickly. But in the meantime, I've just got to wait. So, they were winning. The affiliate marketers were winning. They were getting paid. The brokers were getting paid. The big short sellers were making money. So everyone was winning, but at whose expense? Well, of course, from my perspective, it was at my expense, right? Long biased traders like me, we certainly were making less money because of this short algo. So day traders, but also active traders, certainly, even if you're not a day trader, it was at our expense without a doubt. We were accustomed to stocks with news increasing in value, not with news and declining. But take it a step higher. What about long biased investors? Imagine for a second, that you're not in the stock market, but you're whatever. Let's just say you're a doctor. You're a doctor, and you work with patients all the time. You're a GI doctor, and you've been, as part of the work you do, you learn about these new medicines, and you find out that there's this company developing a new medication for, Crohn's disease or something like that. And you're like, you know what, man, if this thing works, it's going to be a really big deal. I'm going to buy 5,000 shares of this company, and let's see. Maybe I'm wrong, but I think it's probably going to work. And then, a few months later, whatever it is, they come out with news of positive clinical trials. And so as a physician, you're like, oh, this is awesome. This is so great. Soon this is going to really help patients. And yet the stock declines. So you've got clinical trials, maybe it's phase 1, maybe it's phase 2, and they're positive. They're good results, and yet the price declines. Now, you would be probably quite confused if you were a physician or, a novice investor. You're not a sophisticated investor, you're not a Wall Street professional, but you're investing what you know, which is of course what Warren Buffett and many others have always said you should do. And you're following that rule, and yet the price is declining because of an artificial level of selling created by naked short selling. That's not fair. That hurts the integrity of the market. That means that investor, that physician, is probably going to say, you know what, this is just, I'm done. I'm never putting my money in the market again because, I just had this bad experience. And I wouldn't blame them for feeling that way. And so, of course, there's no question that I was very frustrated dealing with this naked short selling. I mean, it's been going on, and so it's frustrating when I see it. I am still left with the belief that eventually they get squeezed, and we have seen a number of squeezes, so I just have to stay tuned for those and then trade them when they happen. But then for an investor who's only in the market periodically, it's extremely disappointing. But imagine a step further. What about the actual companies, right? Can you imagine how frustrating it must be to be sitting at the conference table? You're the CEO of a company, and you're like, all right, guys, this is a great week for us. We just put out, the Q1 earnings. They were 500% year-over-year increase. This is phenomenal. And, your junior guy intern is like, sir, so have you looked at our stock price? And the CEO's like, yeah, what is it up like 300-400%? I mean, you would figure it would be, because if earnings are up 300-400%, then that would track. Well, no, the price is down 33% today. And the CEO's like, what? What's happening? Phyllis, where's Phyllis? Can someone get Phyllis in here? Now, Phyllis is sharp as a tack. You get her in there because she's the one you need when things are getting tough, and she's smoking a cigarette. What's going on? And you explain the whole thing to her. So here's the reality. Jokes aside, here's the reality for these companies. If you sell enough shares, any stock will break. What happens if you're selling more shares on any particular day than there are buyers? It's going to suppress the stock. What if you sell more shares than the entire float? Well, that's what happened with GameStop, and it would have worked, except in that one instance, enough retail traders caught on. But for that one instance that retail traders caught on, how many other companies do you think got forced into delisting, forced into bankruptcy because their stock price kept going lower and lower and lower? So here's the deal. When you list on the NASDAQ, you have to maintain a minimum stock price of $1 a share, even after you've become listed. So if you can keep short selling to push a stock below $1 a share and keep it below $1 a share, they're out of compliance with NASDAQ. Now, historically, NASDAQ will give about a 180-day grace period, time to regain compliance. And there's an appeals process, and it can drag on for a while. So realistically, through this long process and through reverse splits, most companies don't end up actually getting delisted because they're below the minimum price. NASDAQ has been, pretty accommodating in that regard. But what's interesting is NASDAQ proposed a rule change. And this is brand new. They proposed a rule change that if the company has a market cap less than $5 million for 30 consecutive trading days, that the company's automatically delisted. And there is there's no cure for it. There's no, pausing while we do an appeal. You're automatically delisted. And their reason for it was that they said, if a stock has a market cap of less than $5 million, it's just not going to recover. It's not possible. It's going to go to the OTC market anyways. So we're just going to kind of speed up this process, because when you have a stock with a $1, $2, $3, $4 million market cap, these are companies that are very desperate. Those stocks might be more prone to manipulation. They might be more subject to fraud. And then that we're going to protect investors by just saying, if it's below 5 million for 30 days, just get it out of here. So Nick, what do you think about the general approach that regulators and maybe even the exchanges take when it comes to protecting investors, retail traders and investors?
Well, I do think there's a tendency for regulators to be paternalistic. And so the regulators sometimes do things that, in their view, protect investors from themselves, for example. And it's a phenomenon we call protection through prohibition. So, for example, you might see a trading halt in a situation where there's unexplained activity in the market. And the trading halt is designed either by one of the exchanges or by the SEC itself. The trading halt is designed to protect investors from this inexplicable information conduct in the marketplace. That is I think, good sentiment, a good idea, but in fact, a trading halt can have the opposite effect on the people who are holding those shares and be extremely harmful. So I do think it's important to be on the lookout for regulators who want to protect you either from yourself or from a situation that may do more harm. In other words, the cure may do more harm than the thing that's the regulator's trying to cure.
And they submitted that rule change to the SEC, and a division of the SEC approved it. And so in July, it went into effect that any stock with a market cap of less than $5 million for 30 days would automatically be delisted. Now, the Small Public Company Coalition, the SPCC, filed a what was it? Let me just pull up the article here. They filed a petition with the SEC requesting a full review. And so now, as of July 22nd, this rule change has been paused, so it's no longer in effect, pending a full review by the commission. And so this full review is now going to take months, certainly 6 months, 9 months, maybe a year longer. And we don't know what the result will be. But I think it's very interesting that this would happen, because this again feels like, I know when Robinhood took away the buy button, people felt like, wow, they're capitulating to short sellers. Those big hedge funds must have cried to Daddy, and Daddy told Robinhood to, take away the buy button. And while we know now that it was actually an issue related to collateral obligations with the clearing firms, it didn't feel good. It felt yucky. And to be honest, the SEC just sort of rubber stamping or green lighting this $5 million market cap rule feels a bit yucky, because it feels like now these naked short sellers that are running rampant and have for a long time now have this extra weapon that they can hold a stock hostage. If they can just keep it below that $5 million market cap for 30 days, then it'll force the company to be delisted to the OTC market. And when stocks trade on the OTC market, they trade for fractions of a penny versus the NASDAQ or the NYSE or the MX exchanges, because real investors don't really want to buy OTC companies. They just don't. And so what I found really interesting was that as part of the petition, the Small Public Company Coalition did some research on this to question the belief that NASDAQ had that companies that are below a $5 million market cap inherently don't recover. And so they actually found that over the past 20 years, there were 816 companies that would have been delisted to the OTC market, because of this rule change. And of that, 640 of those companies actually later went on to regain a $5 million market cap. That's over the past 20 years. And of those, 212 companies were still above a $5 million market cap as of the end of last year. And of those, several have become multi-billion-dollar market cap companies. And of these, you're talking about tens of thousands of employees. These are real employees. Now, with this $5 million market cap rule, the exchange was saying, you know what, just get rid of all of these companies and forget about the ones that might have survived and all of their employees, because in the eyes of the exchange, some of these companies were destined to get delisted to the OTC market anyways. That was already going to happen. And the moment that happens, investors are harmed. And NASDAQ doesn't want harm to come to investors on their exchange whenever it's avoidable. And that's commendable. I understand that, and I think that makes a lot of sense. But I would ask, how many of the companies they look at as being examples of companies that declined in value, month over month, and eventually all the way to getting delisted to the OTC market, that ultimately caused harm to investors, how many of those companies were subject and victim to a campaign of naked short selling? And I don't know the answer to that, but it can be found out, because if they were victims of naked short selling, then the company's share price was artificially suppressed in order for the short selling brokers and the short selling firms and even the hedge funds or the big traders to profit from that company's demise. And that is not allowed. And yet, because naked short selling doesn't seem to be enforced adequately, it happens. It was happening in 2001 with GameStop. Now, GameStop was just the black swan. It was working really, really well, and these funds were making billions of dollars suppressing and burying stocks until they just capitulated and were gone. They made billions of dollars with that business practice until finally some of them got squeezed on GameStop. But then that was just the one black swan, and then they regained control for many other companies. And these are not just small cap companies, by the way, that can become a victim of naked short selling. So this report on the 816 companies was prepared by the Small Public Company Coalition and also Craig Lewis. Craig Lewis is a professor at Vanderbilt. More interestingly, he was the chief economist at the SEC. He was also the director of the SEC's Division of Economic and Risk Analysis. This is someone who knows a lot about the public markets. And my view from reading and listening to what they've talked about with this proposed rule change is that this proposed rule change would be an absolute slam dunk for the market participants certainly engaging in naked short selling and even legal short selling, because if they could just hold the stock below a $5 million market cap for 30 days, it's a slam dunk win. So if you had a group of hedge funds that all said, we're all short bias on this, you're short, we're short too, hey, that's great. Keep it below 5 million for 30 days, delisted, it's an instant win. So can you just describe where Reg Show came from, what it is and where, in what environment was it born?
So Reg Show is an SEC regulation. It applies to brokers. So for example, it does not prohibit traders from shorting or even naked shorting. If you're a trader, you probably don't even know if you're naked shorting. But it comes from the concern that we've just been talking about, the practice by brokers of putting through their customer short sales without having a corresponding long position they can borrow against. And so really it was a regulation created by the SEC in 2004, 2005 that was meant to address that underlying problem.
Interesting. Okay. And then the failure to deliver list, which was discussed quite a bit during the GameStop short squeeze, keeps a record of the companies that exceed a certain threshold of trades that did not settle, indicating perhaps that there was naked short selling.
Right. Yeah. Massive failures to deliver suggests that the brokers may not have had their belief that they could borrow the shares may not have been reasonable. So certainly massive failures to deliver are good evidence of a problem in the system. There's a big mismatch between the short orders that went through and the actual shares that were available to cover those short sales.
So this is all of the context around this naked short selling scheme. The naked short selling scheme is sort of separate from this $5 million market cap rule. It just so happened that this came up right at like the perfect time for it to be topical, because it came up just after a lawsuit was filed against, allegedly, firms and traders engaging in naked short selling. So now let's talk about that lawsuit. The lawsuit was filed by one company. One company decided to defend itself, LNAI. They said they were frustrated. And I've seen this before. I've seen other companies that have tried to file lawsuits against naked short selling, against brokers, against individual traders, and they accuse them of naked short selling, but I've never seen, and I could be wrong, but I've never actually seen one of these cases succeed. Ultimately, the company just spends a lot of money on litigation. They don't get anywhere. Nothing happens. And they're doing what they feel they have to do and to, represent shareholders and defend themselves, but nothing happens. So LNAI alleges that naked short selling artificially suppressed the price of the stock. And they were able to identify naked short selling from elevated failure to deliver rates. Now, every time a short closes, that's fine. But if a short fails to clear because there was not an original match from a borrower, then it's considered a failure to deliver. And failure to delivers are reported on Reg Show 203. They're reported because the regulators are trying to monitor for potential naked short selling. And stocks can go onto a threshold list if there's been enough failure to delivers. Stocks on threshold lists you cannot short. They also name, in their allegations, they're naming John Doe's 1 through 100 and individual brokers and traders that they think were responsible for naked short selling. Interestingly, they even named a trader who was only short 17,000 shares, a 17,000 share position, which is obviously negligible. But this is probably a regular trader who just may not have even known. They may not have even known that the broker that they were using was enabling them to short naked. I mean, if you short 17,000 shares, you have no idea, right? I don't know. And I think that's a fair argument that when I'm trading, I have no idea if how my broker is getting the shares. So I don't know why I would be liable as a trader if my broker was allowing or enabled naked short selling. But if you knew it was happening and then there was like an email chain and, whatever, text chain between you and the broker being like, I don't care how you get the shares, just get them. And the broker's like, well, they're definitely naked. And you're like, I don't care if they're naked. Then they introduce that as evidence. Then that's obviously going to be a little bit of a different situation. So in their lawsuit, they allege that on March 18th, 6.6 million shares failed to deliver. The following day, another 2.7 million shares failed to deliver. And then on March 27th, an additional 5.6 million shares failed to deliver. So these are millions and millions of shares. Think about those big sell orders, that 100,000 share sell order. This is like 100 of those sell orders, just sitting there, pushing the price down, suppressing the price. It has a real effect. If you've got 10 million extra shares that are sold on the market that weren't borrowed from an actual shareholder, you're creating an artificial level of supply. Additional supply affects the supply-demand balance. And so you can have a company, in theory, that's putting out great news, and yet there's people just dumping shares. Now, this is obviously why naked short selling is illegal, because it does have a negative effect on the integrity of the market. Look, the market is fundamentally long bias. Companies IPO, they sell shares on the open market to raise money to fund the work that the company is doing. If it's McDonald's, it's to buy more real estate, build more McDonald's stores, and expand. And they need all that money to do that. Now, you're an investor in McDonald's and you benefit as the price goes up, as their profitability improves over time. Everyone's 401ks and IRAs and all these pension funds are invested in the market. We need integrity in the market where you don't have naked short selling. Some would argue that short selling, by itself is quite opposed to kind of this American dream of working for 30 years and putting your money in the market and then being able to retire. On the other hand, economists like Alan Greenspan would say that the market is self-correcting. You don't need... Prices will go high and then short sellers will bring it back down. The prices will go low, buyers will bring it back up. And at the end of the day, it will all equal out to the exact pricing to perfection. And so you don't need to overregulate it. You don't need to, restrict short selling, whatever. But naked short selling clearly is a function of an electronic market. I don't think you could have done naked short selling on the floor of the exchange in, 1950. But in today's electronic market, there's a lot of different ways that, unfortunately, we've seen these schemes operate that put companies at a disadvantage. And this is certainly one of them. And you wouldn't normally have, pull a victim card on, a company. It's a publicly traded company. And yet, in this case, they're one of what have been many companies that have alleged this. Millions of shares being borrowed and sold into the market but failed to deliver, meaning they were not properly borrowed in the first place, is a sure sign of naked short selling. So we're in a position now where we heard all about naked short selling during GameStop. We've heard about it after the dot-com bubble. I mean, it's not new. It continues to come up today with this most recent lawsuit. Why do you think it's been so difficult to rein in this problem?
Well, it goes back to the DTCC shares and the ambiguity around who owns what share at what point in time. That's the problem that needs to be solved. So unless you're going to ban short selling outright, which I don't think there's any regulatory appetite for that to happen, or you're going to require actual locates to borrow, not just a reasonable belief, then you're always going to be stuck with these two things: a requirement that you have a reasonable belief to borrow against an ambiguous pool of shares that may or may not be available to borrow. So our view at ICANN is that this probably needs to be solved on a more structural level. There will continue to be private lawsuits like the one that you described. Those occur, with some regularity, and that seems to stop the behavior, at least temporarily. The SEC,
The most egregious
ones, yeah. And the SEC will continue to bring reg show cases against brokers whose bookkeeping, whose tracking of reasonable basis to borrow is not what the SEC thinks it should be. So you'll continue to see those, but it's really this dynamic of brokers wanting to give their customers what they've asked for, which is a short sale, and some short sellers who are motivated by a desire to drive a stock price in a certain direction. So until you solve for that underlying structural problem, I think you're just going to continue to see what's been happening for the more than 20 years that Reg Show's been in place. This dynamic just continues to occur.
So this was filed on May 11th. That's interesting. May 11th. And now they named all the defendants as like John Doe, 1 through whatever, and corporations, whatever. But suddenly, the short selling algo disappeared. You guys noticed that, right? All of a sudden it was gone. Without naked short selling, stocks began going up 500%, 1,000% on breaking news. This was ASTC. This one ended up continuing higher. This one went, let's see, it started at like $4 or $5 a share, went all the way up to a high of $26 a share, which is unbelievable. We weren't accustomed to seeing something like that. Even today, it's still holding up over $9 a share. STI, this one squeezed from about $8, $9 a share to $56 a share. The cost to borrow began going up, making short selling more expensive or even impossible. Trading bots lost money. They had to stop trading. That further reduced the selling pressure. Here's a stock that went from $1 up to $6.50 in one day. This one went from $4 to $18 in one day. This one went from $3 to $24 in one day. These are huge moves. And you might argue, these moves are overdone. This is too far. Well, again, a self-correcting market, these will come back down, and through organic short selling, that's fine. If you want to take a short position on this and you want to use a martingale strategy on it and add, that's fine. And you might catch the one that goes to $75 or $100 a share, and we've seen several of them now since after May 11th, essentially. And that's the risk that you play or you take when you're trading a counter trend strategy. So one of two things always happens with naked short selling. Number one, they get caught and shut down. Number two, they blow up. Number two is more common because unfortunately, the regulators have been slow to, yes, there have been fines and stuff like that, but it feels like giving, one of these giant institutions a $15 million fine is the equivalent of putting a parking ticket on the FedEx truck. They're going to keep delivering in New York City. They're not going to stop delivering. They're just going to pay the parking ticket and go on with business, right? So unfortunately, our better bet is probably the blow up. But in this case, it is an interesting, maybe it's a coincidence that just shortly after that May lawsuit was filed that we saw that algo disappear. Maybe that's a coincidence. Maybe that just happened to happen at the same time. I guess I don't really know. But for right now, balance has been restored. System short sellers are giving up because stocks with news are holding their gains. They don't have this algo that's creating this artificial level of supply that's holding everything back. Long biased traders are feeling safe trading again. The companies and existing shareholders are benefiting from the increased value. Beginning in June, on June 7th, I had no idea about the lawsuit. I did notice that the market had improved. I decided to start a small account challenge, June 8th, with a goal of making donations to 50 children's hospitals in the United States. I grew the account from $2,000 to $65,000 over the course of 30 days. And I wouldn't have been able to do that, grow that account that quickly, if the naked short selling scheme had continued. So now I've donated to 42 children's hospitals out of the 50, donated a total of $435,000 as part of these small account challenges. So here's the deal. Naked short selling will come back. There will continue to be affiliate marketing on social media, Reddit, Twitter, Facebook, whatever. And you'll continue to see people saying, this is the broker to use, zero auto locates, no borrowing, super cheap borrowing. Some of them may be legitimate. Some of them, maybe they've just got a great deal on borrowing, but inevitably they become popular enough. What's going to happen? Same thing. Cost to borrow goes up, availability declines. So now people just can't get shares. People get frustrated and they either leave to go to the next broker, or, that broker decides, well, we don't want to lose business. So what are we going to do? Just give them the shares. Give them the shares, whatever. What's the worst? What are we going to do? Pay a penalty maybe in a few years? Let's do the business now. And unfortunately, we're going to continue to see that happen. So, every few months, there'll be new brokers that open. There'll be other brokers that close, because that's the cycle of these illegal naked short selling schemes. But they always blow up for one of two reasons. Number one, they get shut down by regulators, the broker or the hedge fund or the traders engaging in naked short selling. Or number two, we have an epic short squeeze where we have a stock that suddenly goes up, and just in spite of all of that selling, it doesn't stop rising. The circumstances that create an epic short squeeze like this, obviously GameStop was very unique. What seems to happen more commonly is that shorts will underestimate a particular stock, and the fact that the company is closely held by insiders, and this is especially true with foreign listed securities, that those insiders really are capable of controlling the price even more than the naked short sellers can. And that's when they get squeezed. And when they start buying back those shares, the move is epic. And although you may not have heard of all of those short squeezes on, the news, they might not make it to the news the way GameStop did. Some of them are actually even far bigger in terms of percentage gains. In fact, just since May, I can't even count the number of stocks that have gone up over 1,000% in one day. And I think it's because, at least temporarily, the degree of naked short selling has been reduced as a result of this lawsuit, which is a good thing for now. But again, it's only a matter of time, most likely, before it comes back. And then until the next short squeeze, and the cycle repeats. Now, I have this clip up from Gaming Wall Street, the HBO documentary, and I want to play it again. I'm going to play a little bit longer this time so you can hear a little bit more of the insight from someone on, the other side of the desk, from an actual institutional trader. So let's hear what he has to say again about naked short selling, and he's going to give us a little more detail.
I would, illegally naked short sell stocks every day. Every day. As long as I was collecting commissions.
So that was what we heard before, that he would illegally naked short sell stocks every day. But did the bank care?
And the bank did not care.
In fact, they did not care.
The client will send you an order electronically. All you do is you click on the order, you go to execute, it'll pull up a little box, you type in anything you want, and you just hit OK.
That's, to me, just what's totally crazy about this.
You don't ask questions. You appreciate the order. And if that involves shorting a stock naked, you do it anyway. Because management essentially tells you just create the business.
So now you can see this motivation that we talked about before. You've got a good client who wants to short a stock, or in the case of these brokers enabling system short sellers, you've got an army of traders that all want to short the stock. They want to pay you, the fee, the borrowing fee, which is like the commission. They want to pay you to borrow these shares. And so now the broker is like in this situation where if there's no shares available, they can't make money. So now they're motivated to create the shares.
Anything on the backside, we will deal with.
And I think this speaks to what we saw earlier, also from the GameStop documentary, about how these, multi-billion-dollar investment banks are paying penalties that are a couple $1 million. So that's not at all demotivating them to stop doing what they're doing.
So you're collecting money on the front, you collect money on the back, and you actually have zero risk.
That's pretty insane. So it's a system that's set up so the individual employees have zero risk. If something happens, then management says, oh, we didn't know what was happening. They get a slap on the wrist, they move on, and then it just starts all over again.
Clients never see that. All the prime lenders, they all do it consistently.
What would you propose if you were going to come up with a possible solution? What structural change would you make? Would it be that you require a locate in order to borrow, like a confirmed actual share, and then that share gets taken, or would you do something else?
Well, I think some of the responsibility probably sits with retail traders. So when you sign up with a broker, you may not know this until you go, because who reads the terms of service in the agreement with the brokerage firm? But every brokerage agreement allows the broker to loan your shares. And so one possible solution, and we're actually working with a particular company on this, is to require shareholders to opt into a program where they say, yes, you broker, you may loan my shares. I don't know that it's a panacea, but we're trying to get at the underlying problem, which is the ambiguity around who owns what when and who can loan which shares at what point in time. So it would be like if you had, to continue the airplane analogy, if you had a seat on an airplane, the airplane would have to get your consent before it agreed to give that seat to someone else. A possible objection to what we're trying to do is that it could slow down settlement because remember, this pool of shares at the DTCC exists to allow very quick settlement. So if brokers need to get consent from the owners of the shares, that may slow down settlement. Some of that problem may be addressed technologically. Because we live in a much more digital world than we did when the DTCC was created. So, but I do think that's where the solution lies. It's in the structural makeup of the markets that allow quick settlement. But if we can identify who owns what shares at what time, we won't. The brokers will not be able to loan shares that they don't have permission to loan.
Interesting.
So there's really no question about it that naked short selling is fundamentally bad for the market. It erodes public trust in the market, reduces the integrity of our markets. It subjects stocks to potential bear raids where naked short sellers can artificially suppress the price, either so someone can acquire the stock at a particular price that they want for the purpose of options expirations, or in the case of mid-cap and small-cap stocks, potentially to drive the companies all the way into delisting, which then causes further harm to investors, shareholders, insiders, and employees of the company. In this particular naked short selling scheme, the strategy of using affiliate marketing to bring in retail traders to participate in this scheme, potentially, without even exactly knowing that they're naked short selling, because they funded one of these accounts, they set up their trading bot or their system short strategy. And even if they're doing it in a discretionary way, if the broker that they're using is allowing the naked shorts, then suddenly, they're part of the scheme without even realizing it. And this is the thing where you guys, we have to look out for each other and make sure when we see this stuff that we steer clear of it and warn other people of it, because we don't want to be the one who falls for the bait, funds an account, then gets our money tied up with a broker that ends up getting shut down or the account gets frozen because they're participating in this naked short selling scheme. That's the last thing that you would want. And so it's important that, I put out this type of content to make sure you guys are aware of these schemes. And to the extent that you say, well, geez, maybe I shouldn't even trade small caps at all. Maybe I should trade large cap stocks or something like that. My issue with large caps has always been that, you got a large cap stock that's $150 a share, you jump in, to profit on a move from $100 to $151. Let's just say you buy 100 shares to make a profit of $100. Well, the thing is, you're putting $15,000 of capital on the line for that $100 profit. And so the way I'm typically trading is I'm looking for stocks that are priced around, $3 or $4 or $5 a share. And geez, I could buy 3,000 shares for $15,000 worth. And if this thing goes up just 20 cents a share, I'm up $600. So the return on my investment, I've always felt, and this just as a matter of fact, is higher in small cap stocks, even in spite of the risks that they face. Now, even this year's been a little bit tough because of the extent of naked short selling that we had certainly at the beginning of the year, the first whole half of the year, really. But if you look at my metrics for this calendar year, let's see, this is my audit of my small account challenge, which gets updated at the end of each year. But if we look at just my 2026 earnings, I funded my account at the beginning of the year with $96,000, only trading small caps, well, with the exception of like SpaceX and a couple big IPOs, things like that. And as of the end of July, my account was at just under $2 million. I didn't make any contributions. That was just from actively day trading small cap stocks. And I wouldn't have been able to achieve that type of growth, certainly, if I was day trading large caps, unless I started getting into trading options, which presents a whole additional layer of complexity and risk because it's a derivative and they can expire worthless and so on and so forth. And not to mention the fact that I don't actually know that you would really escape naked short selling with large caps. I know you would certainly have more high frequency trading algorithms, which are predatory in their own right, although those are legal. That creates a whole different challenge with large caps. But to the extent that naked short selling is used to suppress the price around options expiration, because there's always a battle around the expirations, especially the big ones like quadruple witching and things like that, then you're still going to deal with it there. Or some big firm out there wants to push the price down for whatever reason, try to get someone else to capitulate, then you're just playing the tug of war. And it's almost like in that market, you're trading against forces that are so big that you're almost like trying to play chess against the computer. I mean, so that doesn't feel like it's a good solution to me. So, my conclusion is that even in spite of naked short selling, I keep showing up every single day. I keep trading volatility where we find it, whether it's a SpaceX IPO, which happens to be a large cap, or more traditionally, it's looking at the leading gainers each day that are moving up. And typically these leading gainers are small cap stocks. In order for a stock to be up 75, 80%, 100% in the day, for the most part, these are small cap stocks. So I'm going to log into the chat room here just real quickly, and I'll show you. I'm going to put in my username, password, and I'll just show you the leading gainers just from today, just so you can get a sense of the type of percentage gains that we see in the small cap world. But it's exactly these big percentage gains that also attract the interest of naked short sellers, because let's just look here at WETO, which just happened to be today's biggest move. It was the stock I also made the most money on today. Well, this stock went literally from $3.78 a share to a high of $13. That's a 240% gain. Now, I didn't see any of the naked short selling algos on it, the ones that we were obviously seeing earlier in the year. So that's obviously a good thing. But this is no doubt the type of stock that I want to trade. And even if those algos come back, and eventually they probably will, then it's only going to be how long before we end up having one of those stocks that just does something absolutely unbelievable and all those naked shorts get smoked. A great example of this is actually the stock ticker ZJYL. So I'm going to search for this ticker here in my classes. So this was ZJYL. This stock sold off, and we don't know if this was a victim of naked short selling, but it dropped from $27 a share down to about $10. It's a Chinese stock, and it ends up squeezing up and halting. It then opens at 25 and halts a second time in a row, and then it remained halted. And you want to know what price it opened at? It opened at $500 a share right there. if you were doing a system short strategy and just shorting because it hit your volatility scanner is squeezing up there, holy smokes. You could have lost, in this case, an unbelievable amount of money, $2.5 million, on even a position as small as 5,000 shares. So, so of course, this is a great reminder of why I don't engage in short selling, not just because of naked short selling, and I don't want anything to do with that, but because of the fact that these stocks can be completely irrational. And if I'm in a position and it goes to zero, then yes, I lose what I put in it. But if I'm short a stock at $5 and it goes to 500, I am losing far more than I ever stood to gain, which is the inherent flaw with short selling, which is why, in my opinion, this naked short selling algo was deployed to essentially put a cap on how much these stocks could go up, except for cases like this where you have a small company, closely held, not many shares are in the float, and so all of a sudden, shorts get squeezed, and that's what happens. And that's, that one was particularly impressive. This one, same thing, went from $20 a share and spiked all the way up to $220 a share. And then we had Socket it was earlier this week. We had Socket. This one in one candle, if you were shorting and averaging into every candle that popped up, it went from 50 cents to over $4 a share right there. So, again, right now, we're not seeing as much of the naked short selling suppressing the price action on these stocks. We're not seeing that algo aggressively holding them down. But eventually it'll come back, and then all of a sudden you'll get something like this that just absolutely explodes. And that can begin a whole cycle of momentum, as now suddenly shorts either shut off their algo, their trading bots, and or naked shorts get completely smoked, their accounts are blown. And now long bias traders feel confident stepping up to the plate. But it's a real shame when you have a market due to illegal naked short selling has long bias traders that are on the sidelines because they're afraid to put their money in these stocks. The whole idea of the public markets is that these companies list, they put out their shares, they try to produce good earnings, they try to generate profitability, and they want their share price to increase. Obviously, all the shareholders and investors do too. I want to buy into these stocks that on this day are moving, that they're obvious, they're the leading gainer, they've got a catalyst, ideally a strong catalyst. And so when we're in a position where even stocks with good news are getting buried, that's a broken market. That's not a good thing. It's not healthy for the market. So this now puts you certainly on notice. If you see any of those affiliate marketers, just ignore them completely. Take it all with a grain of salt, because as good as that system looks, that martingale strategy, it has an Achilles heel. And when you get bit, it hurts really badly. And I can't tell you the number of traders I've seen who grew accounts and then boom, grew accounts and then boom. And they keep going back because every time they have a nice stretch like this, they think they've got it. This time will be different. But then this always happens. You always get that day. Now, in my trading, full disclosure, I have red days, in case you didn't know. So I make profit, I give back some. I make more profit, I give back some. So from $96,000 on the year to, at this point in August, over $2 million, yeah, I'm doing pretty well. Do I have some red days here and there? I certainly do. Are some periods a little slower because of naked short selling, regular short selling, bearish market sentiment? Sure. It's not a straight equity curve. It never will be. But the discretionary strategy that I trade involving buying pullbacks on stocks already exhibiting momentum is the only consistent way that I've found to make money in the market. And I funded my first account in 2001. It was 25 years ago. So I put my money where my mouth is. I trade this strategy every day. And look, I'm not going to say it's the only way to make money. And I'm not going to say that there aren't short sellers out there that are able to make money and do it legally and avoid, by not naked short selling, and avoid getting caught in huge drawdowns because they manage their risk. However, they are the exception, not the norm. So please manage your risk. And I'll end this episode with my disclaimer that's, as always, Trading in the market is risky. My results are not typical, and there's no guarantee you'll find success whether you trade on your own or you learn from me. So your best bet as a beginner trader is to practice in a simulator and prove you can make money in a simulator before you ever put real money on the line. If I had done that, it would have saved me years of frustration and disappointment as I was losing hard-earned money through trial and error. There is a better way, so please take it slow. And hey, if you enjoyed this episode, I hope you hit the thumbs up or consider subscribing to the channel.